Do you think today's generation understands that risk?
They don't understand risk and they think that I'm saying something stupid.
We are doing something different, Naren. This time around, we are not doing the kya lagta hai.
It was zero.
Yeah.
It was a perfect zero.
And you came back here.
Having lived through 90s and have had a lot of setbacks in that period. So I clearly remember all those days, whereas today people just don't understand those risks.
Naren, thank you so much for doing this for our audience.
It's a pleasure to be part of this.
We are doing something different, Naren. This time around, we are not doing the kya lagta hai and the what sector is good and what sector is not good. We are trying to get a feel of your evolution in the markets. The Indian stock markets, as you know, they are relatively young as compared to say, the US or the developed worlds. The Sensex came in, the base year was 1979 and the markets before that were fundamentally different. You would know that because you started investing in the 70s, which I think is quite unique. What were your early days and your earliest memories of investing or trading or whatever? I want to start from there.
Actually, my father was very keen on investing in FERA IPOs. You know, a lot of FERA issues came up thanks to something George Fernandez did in 70s. Those were all big MNC companies and they were forced to dilute in India. And they were all lottery IPOs, so to say, of good companies. So my father used to invest in them, and he used to, when he invested the first time, he gave me a feeling as though he won something magnificent. So it got me very interested because he was a person who never showed emotion, but on the day he got his allotment, he felt like he had achieved something. So I realized this was a nice lottery and I got interested in it. I had an innate love for numbers at that point of time.
Wow.
So, and due to that, I got interested in looking at these numbers. And that's why I would say in my teens, I started looking at balance sheets and stock markets at that point of time in Chennai,
Wow.
which was actually a non-stock market place where people never looked at stock markets.
That's what. IIT Chennai, what was that like, right? You're with your friends, your roommates, the people who were studying at that point in time. What was the awareness in the stock markets? We are talking what, early 80s maybe?
Yeah, it was zero. It was a perfect zero. And there was absolutely no interest in equities. We are talking of pre-liberalization India. People were only interested in going abroad. You know, in those days, 60 to 70% of the batch used to go abroad to US. And if you ask me where was the awareness, it was how to go to US universities. That was the biggest awareness. I don't think there was any awareness of something called equities in India.
What made you stay back then?
See, that was a personal decision. You know, my mother had passed away at the age of 14 and it was a two-member household. So I decided to stay back in India because I had a very, very good relationship with my father. So I said it's good to stay back in India. So I opted to stay back in India. So that was the main reason. And because in a two-member household, just me and my father, I thought, why should I go to US and then leave my father behind? So I opted to stay back in India. And of course, I wanted to do an MBA and be in touch with the markets.
Amazing. I mean, you're just this you're this excited student who loves maths from what I remember. And you're apart from the entire crowd. Did the students come to you in the fourth year? Because I'm assuming by this time in the mid-80s, the bull run has started because you've got the early set of reforms that came in with Rajiv Gandhi and there was some excitement in markets happening at that point of time. So was there any exuberance that time or there was still?
There was no exuberance in the student community. There was no awareness. I used to tell my father that, you know, thanks to what is happening in the markets, you have to do X, you have to do Y. But there was absolutely no awareness. There were one or two people who were there in my batch who were also interested. That I don't think there was anyone else who was interested.
Everybody was happy doing their fixed deposits.
Everybody
and
was very happy to find a way to go to US.
Okay. So 1989, you graduated, went to IIM Calcutta. What about IIM Calcutta? Here you have graduates who are doing their masters. still any equities or still no equities? Or?
I think there was some interest in finance. I don't think there was extreme interest in equities per se. I think I would say there was more interest in finance, and I would say slightly better than IIT. But obviously, finance was a very important stream in IIM Calcutta. If you look at fund managers in India, a number of them are from IIM Calcutta, because finance was a very, very key stream in IIM Calcutta. But I don't think there was any passion for equity like what you see today in late 80s. That was not there.
So I'm guessing that the MBA from IIM Cal would probably land up in treasuries of Citibank or HUL. That would be the ideal career.
Yeah,
Nobody really thought of jumping into.
Absolutely. Citibank was one of the top jobs along with ICICI Limited at that point of time in IIM Calcutta.
Where did you land up after?
I landed in ICICI Limited actually.
This is the DFI as it was called,
yes,
the Development
exactly.
Financial Institution.
Exactly.
So what were your early days then? Did you spend time in credit, appraisals?
It used to be project finance and appraisals, and it was the best, closest to what I wanted to do, understand companies, and it was the best financial institution, and it was one of the best ways to understand how to look at companies. You know, so far I was always doing my own way of looking at companies, but I got an opportunity from ICICI on how to look at it in an organized way, not in equity, but on how to give loans.
Yeah, and these were the very early days when formal credit for capex and large projects from institutions was a new concept. Till then, I guess it was all PSUs and state and central-led capex. So credit at that time was a place where you learnt a lot, I would say, how companies work.
Absolutely. ICICI was a phenomenal organization to learn.
And you came back here finally. I mean, it kind of comes a full circle when you came here in 2004.
It helped me a lot. Through my entire career, I would say the 16 months I first spent in ICICI helped me because it taught me how to think on how to look at companies and how to do project appraisal. Project appraisal is a lot like equity research actually in a way, and you do much better work, much more detailed work. So I would say that 16-month stint has given me so much to learn over later, although that was nothing to do with equities, much more to do with giving loans, but it helped me a lot in later years.
It was very interesting that a love for mathematics, focus on numbers, and this interest in how companies work and their profit and loss and balance sheets were an early foundation of what eventually became investing. Would I be right in saying that?
Yeah, but at some point of time, stock market itself fascinated me, and I would say we were all lucky that, we were part of this entire market. If you look at it, we saw SEBI come up from controller of capital issues. We saw NSE come up. We saw the entire evolution of the stock market, mutual funds, everything, We were a very lucky generation that we saw all these institutions come up and the entire mutual fund boom, everything. We were a very lucky generation. It's like, one set of people saw how technology came up, another set of people saw how e-commerce came up. But I think we were the lucky generation who saw how these financial institutions connected to markets came up.
Very amazing. And because you had UTI that came in 64 and then you had PSU mutual funds that came up in the 80s. The foreigners, of course, came much later after that. From ICICI, then I think one fine day you decided to join a brokerage in Chennai.
Yeah, in between, actually, I did 3.5 years in investment banking because I wanted
to
be in HSBC in Hong Kong Bank, because I wanted to be very close to markets.
Okay.
So investment banking was the closest I could get close to being in markets. So I spent 3.5 years in Hong Kong Bank in Chennai, and in those days we used to do public issues. And
under CCI?
Under CCI. And later, after CCI closed and SEBI came in 1992 to 94. So I have done issues in pre-CCI and post-CCI, both. And including those years, 91, 92, when we had a forex crisis and you had liberalization, everything. We have seen it all when I was working in HSBC.
And the gold was being sent in a truck from...
And Harshad Mehta and everything, it was absolutely fascinating.
What were IPOs in the Controller of Capital Issues, folks? That's what CCI stands for. What were IPOs under CCI like? I mean, was there any work to do also? Prices set by the government?
No, prices set by the government. Again, it was a lottery.
Yeah.
It was again a lottery. The lottery continued till controller of capital issues happened, but you had to go through a process. You had to prepare a document and get it approved. So that's what you had to do. So it was still a lottery. As far as investing was still a lottery till that point of time, with a good chance of making money.
Making money, yeah. Very interesting. So credit, investment banking, and then the brokerage.
Yes.
What was the brokerage experience like in Chennai?
I think, somewhere I was young, so I didn't appreciate risk. So it was a very good learning for later years. You don't realize that equity market carries risk. Today when I tell people I learned it in 90s that equity market carries risk. But at that point of time, I never knew that equity market carries risk. That's why I left a good job in investment banking in HSBC and became a stockbroker. First 18 months, markets were booming. Then the markets started to crash. And then it was a very difficult experience.
Yeah, the 90s were pretty rough. We had an entire lost decade where I think the Sensex just gave some 3% over 10 years, which was insane. I mean, it's interesting that you say that you learned about risk at that time. When today we live in an era when the 1-year returns on the stock markets have been positive for almost 8 or 9 years at a stretch. A lot of people coming in now just extrapolate 15% forever. And do you think today's generation understands that risk?
They don't understand risk, and they think that I'm saying something stupid when I tell them equity market carries risk. And having lived through 90s and have had a lot of setbacks in that period, so I clearly remember all those days, whereas today people just don't understand those risks.
Yeah, and that kind of stays in your psyche somewhere. Once you've burnt your hands, it's no matter how old you get, no matter how much of investing you do, somewhere it stays, like in your memory, hidden somewhere of something. Right? It
Absolutely.
Does. Yeah.
And it definitely helps you to see, accumulated experience helps you, but in big bull markets, it hurts you.
That's a nice way of putting things there. Tamil Nadu Investor Association, I just love this association because it's quite old. What was it about? Where did you discover them? What difference did it make to your career at that time?
See, there are two things here. One is the formal Tamil Nadu Investor Association. I used to attend their meetings. But more than that, actually, we had in 97, 98, many of us had actually got burnt by the stock market between 94 and 97, 98.
There was a series of scams happening.
A series of scams, and most of us had lost everything that we had made. So in 97, 98, for about 6 to 8 of us, we realized that all of us had made big blunders in investing. So on one Saturday afternoon, we started to meet every Saturday afternoon to basically introspect on our mistakes. And that was not the formal Tamil Nadu Investor Association. This was just an informal group run by a person called Mr. Chadda. And that allowed us to open ourselves to our mistakes and introspect on our mistakes. And that helped us to understand what kind of mistakes we made in investing from 1994 to 98.
4 years.
4 years. Actually, the mistakes were that we actually kind of didn't realize what we were doing, and when we made the mistakes and lost money, we actually came to this group and found that everyone made those mistakes. So we used to discuss that on a continuing basis over 98, and then when the boom started in 99 again in tech, we just stayed out of it.
Wow.
And to stay out of it in that boom was much more difficult.
I mean, your FOMO, your fear of missing out levels would have been insane.
Insane. And I was running a stock brokerage where I used to tell people, don't invest in Pentamedia, don't invest in Himachal, don't invest in Global Tele. And people used to get, don't invest in DSQ software. And people used to get crazy saying that, what are you telling me?
Because these stocks were doubling and tripling in weeks.
And, it was so difficult to handle investors at that point of time that people used to say, Naren does not want us to make money. But then we had this experience of 94 to 98 with us, that when you have madness in the market, it will end. And that was something we knew because that was our biggest learning from 94 to 98.
To be cautious.
So we be careful, and it eventually played out. By that time, I had decided to come to Bombay, but almost all my customers of the brokerage firms still remember that I had given them sane advice in 99, 2000.
When the bubble burst and then everything
Yeah.
went down. I find this very fascinating because what happens for a lot of retail investors is when they have this kind of an experience that scars them, they decide to run away from the markets. This is not for me.
Yeah.
Okay, I mean, I've had this conversation when I had become a CA about how the stock market is a gambler's den with my father's generation and the ones before. I mean, you obviously don't enter that. I mean, what is a gambler's den? A gambler's den at that point of time used to be Satta Bazaar, Teen Patti, Matka. That's what the comparison was. And from there in the 90s to a valuation-led approach, looking at balance sheets, cash flows, everything started changing. You could sense that. I'm just trying to understand that what held you back to stay and make us take in the markets as a career versus just saying कि ये मेरे से नहीं होता है अभी. When here's an IIT, I am, top 1% educated of education. What made you stick it out? I will still make it.
That is what I don't know. That's why I think this group of six of us, each of us have continued in the markets. And each of us have believed that, markets is a great place. And then we all changed ourselves and learnt a lot of new things. We learnt that we have to handle temperament. Yeah. We realized that the biggest problem in investing is not knowledge. The biggest problem in investing is temperament. And subsequently, we have made a lot of effort, and that's what I would say. And somehow, having seen 1989 to 94 profits, we felt that this is a good place. It is just that we didn't handle it well. Yeah. So we always had faith in the stock markets, and if you ask me, even today, we still have faith in the stock markets.
Yeah, I know. So before you started your career on the buy side with ICICI, you spent a lot of time on the sell side also.
Yeah.
I think you were in a couple of places as an analyst, as head of research. So what's your view on the sell side's role today? What role do they perform in institutional equities? You think that they are instrumental in the research and everything?
They give us a phenomenal amount of support, but you have to take your own decisions. And the amount of support we get from sell side is just unimaginable. They give us valuable insights, but you have to take your own decisions. There are times when you have to use what they say, what they tell you to do, you can do exactly the opposite. But the amount of insights that they give you is unimaginable. And the quantum of research that is available, the quantum of insights that is available is just unimaginable today. It's very different from 90s.
It's very interesting, because there are not so many people who've had long careers on the sell side, but there are many people who've had very long careers on the buy side. People who started in the 90s when the mutual funds had just come up and they are still there, either doing the same role or in another organization or setting up their own funds. Sell side is relatively smaller to that extent. What made you go from being in institutional equities to a fund?
Somehow, first, I think there is no better organization than ICICI. I got such a great opportunity to work for ICICI. So that was something which was good. Somehow I always felt that buy side, and that too for ICICI, is an opportunity I was just waiting for. I never expected that I will get it. And you have to imagine I got it at the age of 38, not a young age. And to get such an opportunity in ICICI was a dream come true for me. So I just grabbed the opportunity. And I felt that, first of all, I have this view that buy side, the way it is organized, is better for the long run. And, in the basic concept of sell side is transaction oriented. The basic concept of buy side is stock oriented, which means if I have got investors in and they are with me, then I don't need to trade for them to make money. If they are with us, the transactions is not important. Whereas this whole brokerage industry is built on transactions. The whole mutual fund business is built on assets under management. So that makes this industry far better for the long term. So when I got such an opportunity for such a great brand like ICICI, I just grabbed the opportunity.
Amazing. And if you're watching this, remember folks, that's a very valuable piece of career advice if you're looking at joining the stock markets, on which side to be. In 94, you were at the end of a bull market and had a very bad experience in the next few years that happened. 2004, you're in a fund and looking at what was then the biggest bull market that India has seen, 2003 to 2008. What were the early days like for you?
The early days were just phenomenal. We would look at a company and say, let's buy this stock. And that stock just doubled in between 2004 and 2006. So it was just such an easy time. We just had to do simple work. And then in the next 1.5 years, those stock doubled between 2004 when I joined the company and 2006. The tough part was in 2007. In 2007, to avoid the mistakes and actually tell people that, you have to be careful and you have to actually be conscious that you are managing public money. That was very difficult, because I was managing the infrastructure fund. So we met so many companies in India, and those companies were not companies which we felt had the right corporate governance. It was one of the toughest times in investing, because the companies did not know what they were doing. They were trying to come to us and say, we want to raise money and from you, or do this project, do that project, and most of those projects were not thought of properly. And I think 2007, handling money, public money, was very, very tough.
So I'm just trying to understand this from, let's say, a corporate angle, because we see a lot of startups raising money. Capital in India has always been a little bit starved. Its access to capital has always been restricted for the mass public, for entrepreneurs. So if you look at, say, the late 70s, it was an IPO of Reliance that opened up an equity cult. If you look at the tech boom in 98, 99, that was another breed of entrepreneurs who all came to the stock market because of Y2K, ERP, etc. In 2007, you had the infrastructure boom. So from an entrepreneur's perspective, do you think in today's day, sitting here in 2024, when they look at raising money from the markets, what is their outlook when you meet a promoter today, whether it is corporate governance, minority rights, or how to be there for the long? Do you think something has changed from when it was, say, 30, 40 years ago?
Things have improved, but still you have to remember, today the problem can be that they try to sell you at an inflated price. The problem may not be governance. The problem today is valuation.
Okay.
So today what happens is the best companies come to us through the private equity route. So they have been first a private equity investor has invested in them. They have invested at X. Then they then they get listed at 10X. So we are not buying at X, we are buying at 10X. They may come with much better corporate governance, but then you're buying at 10X. Is it worthwhile to buy at 10 times the price at which the private equity is bought, or 20 times the price at which the private equity is bought? Maybe the governance standards are okay, but the price is okay? So if you ask me, the situation is one and the same.
Okay.
The cycle is different. The type of companies which came to the market in 94 is different. The companies which came in 99 is different. 2007 is different. 2024 is different. But the task of managing public money is equally difficult in 2024 as it was in 2007.
These poor guys don't know that they're sitting in front of someone who sat in the 80s and looked at, project appraisal, and they think that they can pull a fast one or something.
No, but it is very difficult for us. If at the end of the day, if you are the only person taking the decision, that is okay. There are so many investors today. So you pass up an opportunity, and on the day one of the IPO listing, that share goes up 30%. Then you ask yourself in disbelief, you thought that it was not worth 10x. Now it has become 13.5x because on the first day it has gone up 35%. So then you ask yourself, what did you miss? Is it only your gray hair which is responsible for missing this opportunity? So some of my younger colleagues ask me, have you been too cautious? So I have to answer them on top of thinking of how I've handled public money. And this public money comes to us because of this brand called ICICI. So the problems that exist for us is not small.
Man, you just keep revisiting the same things again, right? I mean, I look back at 94, or rather the tech boom where you refused to go into software and people said that Naren doesn't want us to make money. Now people are asking you the same question.
Exactly. So, you think of 94, 95, you think of those days in 95 when you started to lose money. You think of 89 to 94 when you made money too easily just because you didn't know enough. Then you think of 99, then you think of 2004 to 7. So many things come in your mind, and actually you think, where are you? Are you doing the right thing for your public investors? These are things which keep coming in your mind and actually make the decisions more complicated. Sometimes I think if you don't have experience, it's easier to take some decisions.
Or if you could just press a button and wipe your memory and then jump in.
It's not possible to wipe memory because all these memories have not, these things have happened over a long period of time. You've gone through this entire motion, and it is not a 35-year period without where you've done so many things, and you can't wipe those memories. It's impossible to wipe out 99 to 2001. It is impossible to wipe out 2007-8. See, it is that memory which allowed you in 2020, in the year of COVID, to go and tell people, we will buy. The world is not going to end. The markets are very cheap. We have to buy. It helped us because the past helped us. But today, in 2024, at 2024 valuations, when you're handling public money, we have to ask ourselves, are we doing the right thing? Are we making a mistake? Are we making big mistakes? Are we making small mistakes? Are these small mistakes okay? These are questions which keep coming to us.
Amazing, yeah. I would not even think about this sitting there and letting my SIP money go month after month after month, and the guy who's handling it is facing this kind of a thought process. Crazy.
Yeah. Actually, we would have, when I joined this company, where people say you never get forecasts right, when I joined this great institution in 2004, we had 2,000 crores of equity assets. Today we have 5,30,000 crores. I would have never imagined in forecasting that in 20 years we would have gone from 2,000 crores to 5,30,000 crores.
Wildest dreams.
In my wildest dreams, the brand called ICICI, coupled with all the regulation that SEBI did over the last 20 years, coupled with all the growth story that ICICI India was, has helped us in this 265 times growth in 20 years.
Yeah, just amazing. Let's talk about the psychological support, Naren, because I want to just delve a little bit onto the dark side of things. You've already started that thread of thought. I just want to just go a little bit deeper in that. What helps you? Like you've spoken about how the Tamil Nadu Investor Association during the tech bubble was a good support for you. Every time this repeated, where did your support come from?
Oh, I have phenomenal support. In my team, I have not recruited a fund manager from outside.
Okay.
So I don't have, as of now, a fund manager who has worked in any other firm. So all the people have been internally trained to become fund managers. So when we get into any investment and that investment goes wrong, like telecom took years to deliver, PSUs took years to deliver, metals took years to
Real
deliver.
estate, yeah.
So in all these stocks sectors, we have an internal support team. Instead of Tamil Nadu Investor Association, we have a support team within the team. So there are sector analysts, there are people who have covered sectors in the past who have now become fund managers. So all those people are all internal support. So without them, you can't hold these positions. Yeah. So we have support team. I would have had a support team for telecom. I would have a support team for power, support team for metals. Sure. Otherwise, you wouldn't have been able to hold those positions for 5 years, 5 or 6 or 7 years. And sometimes to avoid, if you ask me, there are banks and NBFCs we didn't invest in. And those banks and NBFCs kept going up. So we thought, are we doing the right thing? Are we doing the wrong thing? Finally, in 2020, it worked all of a sudden. But for 3-4 years, we thought we were fools. But again, we had to have an internal support team. Between risk, equity and debt, we said, no, we will hold on to this position. But see, the problem with all these things is timing is not clear. You think it will work in 3 months, it takes 3 years. Sometimes some things which will work in 3 years will happen in 3 months. In 2020, if everyone knew that the market will zoom in the next 1 year, they would have all bought more. But no one knew then that the market will turn immediately.
I'm trying to think of people who invest now in the markets, or at least who started in the last 4 years. This new generation that has jumped in when the COVID crash was happening, right? And now here we are 4 years later. They go through similar things as you, investing in sectoral or thematic, or finding out that the SIP is not even giving FD returns. What's your message to them? I mean, how do you actually stay rooted, grounded, invested in the long term, even when the numbers or your Excel sheet is showing you that maybe you are better off just going to an FD?
But first, they cannot be investing only in equity. If they have invested only in equity from 2021, or they are over leveraged due to equity, they should cut it even today. Market is not down. Market is up substantially. So the time, there is a time to take the right decision. The time to take the right decision was not post Lehman and say, I am over invested in equity. Or the time is after COVID is not the day to say I am over invested in equity. If you are very over invested in equity, you can even come out today. I'm talking now. December 2024. But that is the challenge, that people have to understand where they are in asset allocation. The introspection we made in 1998 when we created this investor association is 94-95. When we look back, we found that the market was meaningfully overvalued. But we didn't cut our equity position. We kept on buying. We even leveraged ourselves. Because we never realized that markets could ever go down. So the question of, in 1998, we realized that the biggest mistake we made in 94-95 was not stock selection. The biggest mistake was getting leveraged in equity in 94-95. So like that, one has to understand how much money do you put in equity at a point of time. In 2020, it was so crystal clear after the fall that you had to buy equity at that point of time. So it was very clear. So that is the challenge of investing.
So this clarity on asset allocation is something that people don't get, especially people who are, in their late 20s or have just started their career and think that whatever they think is right. Just give me one takeaway on asset allocation and why it's important. I just want to make that point for our audience.
See, asset allocation is very simple. Buy an asset class which has done badly. If real estate does badly from 2013 to 20, for 6-7 years, you can buy real estate. If gold has done badly for 7-8 years, you buy gold. If equities has done badly for 7-8 years, buy equities. So this is the simple thing I tell people. You identify any asset class which has done badly and put some money into that asset class. Then you make money. But that's the toughest thing to do.
Exactly.
In 2011-12, we used to go to Gurgaon and tell people, don't leverage in real estate. Instead, put money in equity.
This was the peak of the real estate
cycle.
Peak of
the real estate cycle. So it's simple. Similarly, if you have made too much money in an asset class, come out of that asset class and move to an asset class which has not done well. Simple.
Counterintuitive, that's all.
It is counterintuitive. All we say is keep booking some profits and move to an asset class where people seem to be most unhappy.
It has come easy to you, but after many years of experience and getting beaten up and spending a lot of, sleepless nights. Okay. Investing process. Let's talk about how it stands today, how it's evolved in the last 30 years. What are your frameworks of valuations? For spotting opportunities, you just said it right now. Look at something that's out of favor, out of flavor. People are running away from it. It's not performed well. So do you have a framework or a mental model about spotting these opportunities and then assessing how good are they actually? Because sometimes if the market is not favoring a certain sector, maybe there's a reason for that. Balance sheets might not be doing well, dubious promoter quality, etc. So how do you really sift through all of that?
See, one is you have to see, we manage large sums of public money in ICICI. So what happens is we have to put decent amount of money to work. Our goal is not to put a few lakhs in something. So for us, identifying an opportunity involves being able to put meaningful money to work. So for us, what happens is, while we do get to meet companies and understand the sector, normally I became a contrarian because of that reason. Because for us, if we have to invest in something and we need to buy good quantums, we have to be able to identify some opportunity which has become cheap. And anything will become cheap for a reason.
Yeah.
So today, for example, like in December 2024, what has happened is globally people haven't gone back to work in offices. So everybody sells offices. So office REITs are today the worst performing asset class in the world. So we will look at that area, do some work and say, okay, let's look at office REITs as an opportunity. So today, for example, what we will do is we look at all the underperforming sectors. Let's take FMCG as an underperforming sector. We'll do work on it.
Sure.
And in that, we'll try to see which company is the best company to look at. Suppose mid-cap cement has done very badly. We'll try to look at what are the mid-cap cement companies to look at.
Yeah.
And that is the framework which we have to use. But if you look at, for example, I have colleagues in my team who are growth investors. What they do is they go meet companies. After meeting companies, if they find that that company has a good growth path and they feel happy with the vision of the company and they feel that the company is doing the right things for the next 3 years and that company will gain a lot of market share in the industry that they'll do. They're happy with the governance standards of the company. They'll buy that company irrespective of valuation sometimes.
Yeah.
So I would say that you have to follow a model that is, I would call the Peter Lynch model, because if you had to look at what it is, best written book would be Peter Lynch Beating the Street kind of book, where what he suggests is you go to a supermarket, see what is selling better, and then think of what is happening, what are we doing individually different, and then see what are the habits that you have changed. The habits where we have changed significantly, look at what stocks correspond to the habits that we have changed most and buy those stocks. If you can meet them and also feel that that company will work for the investor, that's the best kind of company.
Yeah.
So these are some of the processes. But as an individual, I have become a contrarian because I am managing on behalf of ICICI large amounts of money. So for me, buying small quantums don't make any sense. So in 2018, 19, 20, it was to buy telecom stocks, it was to buy metal stocks, it was to buy PSUs. Because in those days, PSUs, metal and telecom were the sectors totally out of favor. Today, it would be actually mega caps, not small caps. It would be FMCG companies we would look at. We would look at all those kind of. That is the framework that we do at this point of time.
So every model, every framework will have that time when you start questioning it.
Yes.
When you are approached by this line that, boss, this is not working. The market's telling you it's not working. Okay, you go into it with a lot of conviction and things just don't work out. You just wait and wait. Like you said, 3 months go by, 3 years go by, and then, you know, that bet is not working, and then you have to take a tough decision. Maybe that works or not. Maybe the market rewards you after you have left that and you just feel a tremendous amount of regret. I'm sure you've been through that also on both sides of the equation. Either selling too early, okay, and missing out what happens later, or buying too late, or whatever it is. So, you know, where is that line where you have to accept that I have to change my process? Otherwise, if I'm stuck, I'm stuck. It's like what you had gone through in the 90s, right? When you refused to go into tech, but at some point of time, you know, it's a dark place to be in. So where do you know, whenever you've been faced by these lines, what has that experience like, and how have you come out of it?
See, we have had mistakes. Like, for example, I bet on a tea plantation companies had not done well. So I bet on a tea plantation company. But that company indulged in a wrong corporate governance also at the end of it. So there I had to book a loss. But normally when you go through these opportunities, and we do it in scale because we manage large public money, and if you go wrong in it, you actually end up losing money. So in this tea plantation company, we lost money. Yeah. So what happens is, this is what you call that's why what we do is, when you apply contrarianism, you have to do the right work also after that. Suppose we had bought one of those NBFCs in 2018 which went bankrupt, that would have been a disaster. Yeah. Luckily, it didn't happen to us because we had done good work and we did not bought any of those NBFCs. Yeah. So in a way, what we try to do is we buy commodity stocks, because commodities tend to change. So if you buy steel, at some point of time, steel prices change. In the case of tea prices did reverse, but by the time tea prices reversed, that company had gone bankrupt.
Yeah. Well, what is your framework to sell? Because what happens is at some point of time, your position that you've taken, whether it is a stock or a sector or whatever is your mental model or a framework, becomes uncomfortable. Where you can see there are certain signs. Psychologically, there's still that thinking like 10% more, 20% more, and then I'll sell. So this framework to sell or handling regret, because ultimately whatever you do is going has a good chance that it will end in regret. How do you deal with that? Any examples that you can?
Here, I have one point. Basically, I feel that most investment literature is focused on buying. Very little is focused on sizing and I would call selling. And the most important skill set that people have to develop to become better investors is sizing. Because what happens is sometimes you have identified an opportunity, but you're not bought enough. So there are times when you have to size, which means you have to buy enough of that. So if you have decided that you have to buy Indian equities or Indian large cap equities, if you buy 2% of your net worth, then it won't make any difference. There are times when you have to buy big. So that's called sizing. So, and people have to spend some times at times to think how much of my money I'll put into this idea. That is called sizing. And people don't spend enough time on it. The selling decision actually I learned from one of the people in the investor group only. So he said that, what used to happen at one point of time was you sell a stock at 12 rupees, then at 14, then you sell it 16. Once it goes to 18, you stop selling. Because you have regret. 12, 14, 16, now it's 18. So what he said, ignore that. Do only switches.
Wow.
So he said, you sell at 12 and buy X, another thing, and do this as switches. Okay. Then he said, you will not have regret. So whenever you're doing anything, think of it as a switch. So you sell X company to buy Y and evaluate all the sell as switches. Then you will find that you have less regret. Suppose you, even from an asset class point of view, you decide I'm going to sell equity to buy gold. Think of selling equity to buy gold. You will find a ratio. I'll sell Nifty, when Nifty to gold ratio is this much, I'll sell some. When it goes to this, I'll sell some more. If it goes to this, I'll sell some more. Then you will have much less regret. Otherwise, what happens? You will sell as it goes up, but once it goes above a certain level, you will start saying, I've always been selling, I've lost money because of my selling.
Yeah. I mean, psychologically, this is just a game, right? I mean, you just have to be up with it.
That's why finally, if you ask me, everyone believes knowledge is the way to make money in markets. It is temperament is the way to make market.
Wow.
How you can improve temperament is what I've been struggling. One of the things is it's very tough to build temperament. I'm trying my best by recruiting fresh people to see whether I can build temperament. But I'm not yet clear whether temperament is genetic and it can be built. I'm not clear on that. I would love to hear your view after over a period of time whether temperament is genetic or whether it can slowly improve over time.
It's a wonderful thing to think about and probably do some more research on it. Kind of also reminds me, since you mentioned Peter Lynch, one of the quotes in his book was, how do you identify a bull market? When you go into a party, normally you're the one giving tips, and when it's a bull market, it's somebody else who's giving the tips to you. Does that happen very often? Like you?
Yeah.
So, and how do you react to all that?
Luckily, compliance rules are very clear that you cannot give tips, so it makes my job very easy. So normally I'm always on the receiving end of.
Okay. Retail behavior as it stands today versus when you started investing. Right, here's the thing, right? So India has seen bull markets a lot in the past, and you had retail coming in and going out. I think in the 80s and 90s, what happened was that the bull markets, retail would come, get burnt, and then go, and then never come back saying it's a gambler's den or whatever. And I think that this time around, what's changed is that the SIP book, whatever. I mean, it seems more permanent. Do you think something has changed? People are getting more mature, smarter, clever, or here also the story is once the Nifty falls again by 10%, again you'll have some people stopping their SIP and saying this is not for me.
I'm hoping.
Okay.
See, I would like to test the SIP book when the market falls, because at the end of the day, this is the temperament question I answered. See, many of the investors have not been what shall I say, they have not gone through a seasoning cycle of the markets. There are too many investors who believe that equity is a permanently return generating asset class every year. And after 2011, there's not been a down year in any calendar year. So too many people are there in the markets who believe that equities never generate negative returns. So I would like to see what happens when it delivers negative returns, because I'm worried about that. So I would say that, when I see investor behavior across the world, I have not been able to see investor behavior across the world saying that people have changed. Forget India, where I can't answer. But across the world, I see people they're being over positive when markets are high, very negative when markets are low. I'm seeing that behavior across the world. So if you take 2021, people in US did all kinds of structures, like that SPAC. It was called SPAC. If you looked at that SPAC, in the most sophisticated country in the world, how could you create a structure called SPAC which didn't look logical at all? So I feel that nowhere in the world have people been able to be very unemotional about investing. My guru Howard Marks says it never happens. So that's why I'm hoping that in India, investors are different from the world and they will maintain their SIPs when markets go down. So whenever anyone comes to me in any public meeting and say, I want to do a SIP for 20 years, I tell him, will you do the SIP for 20 years? Will you give me a guarantee? Are you sure? Have you ever done a SIP for 20 years in state? Did you invest in value discovery for 20 years? They don't give me answers. So I tell them, if you genuinely think you will do a SIP for 20 years, I can give you this advice. But I'm very worried whether you'll do a SIP for 20 years. You're telling me this, but I'm not sure.
Yeah. The value discovery for 20 years has given stellar performance, right? I mean, anybody who invested then, or whether through lump sum or whether through SIP, and just stayed the course, didn't do anything, just stayed the course. Go do your job in the morning and let this fund make money for you.
It did. But that's what I'm saying. The challenge is that, securities market carries risk. How many people did that? Very few people would have done that. So that's my challenge. That's what I try to tell people. Investing is easy, but how many people do it? How many people in 2020, our inflow should have been much higher than 2024. It didn't happen.
Yeah. That's a fact. You mentioned Howard Marks. You stated that your gurus are Mauboussin, Michael Mauboussin, James Montier. This is the list. Any additions, deletions?
No, I believe, I have a view that actually investing is not about keeping on accumulating new theories. It is about implementing those theories systematically. I find a lot of people reading too much about theory but not implementing. So I'm very worried that am I implementing the theories properly? If I implement the theory properly, and ICICI has given me a beautiful job to manage public money, if I manage the theories properly, that is good enough. Investment theory hasn't changed. That is why Warren Buffett has been successful for his age. Because investment theory, unlike technology in computers, hasn't changed much. It is important to actually use the theories sensibly over a period of time and not give up on them at the wrong time.
Amazing. It just boils down to something as simple as that.
Yeah.
And yet people complicate it by reading hundreds of things and not implementing them. Okay, just winding down the episode now. Where do you find solace outside of the markets? Do you have any interest,
See, I listen to music. I listen to Carnatic music, particularly of the older people whom I used to listen to.
Yeah.
I play computer bridge, and I basically have a simple life, considering my son has a genetic disorder. So I live a very simple life, and I'm not a socialite or something like that, and I enjoy my job. So thanks to that, and every day something happens. Either globally something will happen, like either something Fed will do, or Bank of Japan will do, or something Chinese policy makers will do. It keeps me on my toes all the time.
Since you mentioned it, it's amazing the work that you and your wife have done to bring about awareness for the genetic disorder of your son. You just spend some time on that. Maybe there's someone out there who doesn't even know about it, and this will really help him.
No, I think my son has a disorder called Fragile X, and I would say that there are people who have done more. But what worries me is that many people don't recognize that there are things to help, and in the form of off-label medication and things like that, and various things, and they just basically give up. And I believe that the world has moved on, so therefore there's so much of things that can be done to help, and there are thanks to the internet today, all that is done in US is available for you to see, and therefore I would say that parents should actually try to see what they can do to help their children. And amazing work has been done by some of the people in creating institutions also, like Suresh Subani in Calcutta, and Mr. Chakrapani in Bangalore, and many others. There's another institution in Chennai. All of them are doing very good job actually in trying to create institutions also. Hats off to them.
I don't think anybody even heard about this.
Yeah.
I did some research because I think you'd mentioned this to Saurabh in Gurus of Chaos also. So it's just fascinating that when you do a search for this, I think your name, your wife's name is there, like at the forefront of
No, this has to be done for the broader number of disorders rather than this, because at the end of the day, I would say that these people are doing a lot of work actually. I'm doing much less than what they are done. I'm doing nothing actually.
I think it's still, I think it speaks a lot of the, probably some lessons on the market of having strength in character also helps you to deal with this kind of situation.
Yeah. But I would say that actually it helps you to, you have to be grounded. Yeah. It helps you to stay grounded, if you ask me.
I wonder if that's going out of fashion these days with the young generation. Okay, last question, Naren. Any advice to our audience, to handle their portfolios, just temperament. Let me just put it in the word that you described. How do they handle their temperament and stay the course for a long period of time in the markets?
No, I'm kind of worried actually at this point of time. The way Indian industry has developed, I see too much of volumes happening in the derivative segment. I'm of the opinion, and the regulator has brought out enough papers also to say that it's important that investors should not become traders, and it's important that investors should recognize that money making can't be so easy. And I have actually given interviews saying people shouldn't become full-time investors, because money making can't be so easy that they decide to become derivative traders and say I'll make money easily, etc. I think this is a phenomenal part-time activity. You do your job, and then along with it think of long-term investing, and over decades this will be a very, very good way to actually create wealth through mutual funds, and if you feel like even direct equity. But the moment you try to become a trader, it becomes much more difficult. That is my only request to every investor in India. And since India is a good structural story, and I have been the beneficiary along with, and ICICI gave me the opportunity to manage public money over the last 2 decades, I would say that all of you will also benefit over the next 3 to 4 decades, because India is one of the best structural stories, but you can't be a trader.
Yeah.
And use temperament. Knowledge is not the problem. Knowledge has been democratized.
Amazing. Look at that. On that note of optimism and learning how to do things right, that is a wrap on this episode. Our guest, as always, S. Naren, ED and CIO, ICICI Prudential Mutual Fund. Naren, thank you so much for doing this for us.
Thank you.
Great to have you.
Thank you.